Hello, my name is David and welcome to David Computes. In this video, we'll be looking how to use Excel to calculate some basic statistics on gaps. As usual, I'll be using the Standard & Poor's 500 data. In this case, as you can see, I'm using the same data set I've used in previous videos. It goes all the way from January 2004 to 2021 end of July, or almost. So roughly just over 17 years of worth of data. So we have our data here. I've prepared a lot of things in advance to save us some time, but just let's look at each one of them. So from column A to E, this is our data set. And then I've calculated our usual columns with the number of points gained during the session, so basically the close minus the open, as you can see from the formula there. And then I've added another column where that same data is shown, but in percentage, which was much more relevant, as you know and explained in previous videos. Feel free to check them previous videos below. And again, I've done all this for the entire data set. And then, and this is what we're covering this video, the gap. So the gap, what is it defined in this case? I've defined the gap as the difference in value between the previous session close and the current session open. So if you look at the formula, you can see there, and I just calculated directly in percentage. I did not add a column where I had the gap in points, because again, we're only interested in seeing it in a percentage. The points do not give you a good view on the data because it's distorted depending on the number of points on the index. So the percentage, it always gives you the right view of the gain or loss. And again, so I added here, and then I did our usual basic statistics. I've counted how many entries we have, how many of those were gain, how many of those were gains in a percentage view, and the same for losses, and then an average, a sum of the entirety, and a maximum and minimum. And again, I've done a few controls here, just to make sure I had not done any errors on our data. And so this is the very basics if you wanted to calculate using Excel very quickly the gaps. The difference between the previous day close and the current session open. In this case, obviously, it's a daily session for the Standard & Poor's 500. So what can we see immediately just by calculating all these columns from A to H? So I've summed here all the gains that the sessions had during the day session. So that's just the sum. And here I've calculated the sum for the gaps. So the immediate thing you can see just by seeing this, it's actually the gaps seem to be responsible by just approximately half the gains. So just a first close look into this data seems to imply that half the gains are done overnight or are done in gaps. So when the trading session, the pit session, or the cash session, it's some like to call it, is in trade, is open. So it seems there's a lot of movement overnight and implies there's a lot of gaps. And as well, you can see that there's around 52% of the gaps are positive and 47% of the gaps are negative. So it seems to imply that most of the time the gaps tend to be on the upside. Okay, so after having this first calculation, we already see there's something interesting going on with the gaps. What we're going to do is something we've done as well in previous videos. Feel free again to check them if you want to see how they're calculated. But again, what I've done is I've broken down this data on a yearly basis. So I've broken down all the way from 2004 from 2021. Mind that 2021 is not complete because our data set only goes to July, but it's there anyway for just sake of completeness and mentioning that chunk of data all the way to July. So again, what I've done is I've calculated the data on a year basis. Again, similar to what I've done before, I use an if operator there to see. So I say if the year on cell A16 matches it here, there, then put the gap data there. And I've done that for all the years, as you can see. If I scroll down, there you go, and you can see the data there. Now, again, I've made a count just to have an idea on how many days of worth of data for each one of the years. And then I've counted them again, how many were positive and how many were negative. So we can see some interesting data as well. There's quite a bit of fluctuation on the data. For instance, it seems that in 2004, the upside gaps, so positive gaps where the open of the current day is higher than the close of the previous day, is actually quite significant. So only 39.8% of the days actually had a gap up, as opposed to 60% had a gap down. And again, the point of the view is not to go and analyze this, but I'm just showing you some simple things that you can do it yourself, and you can try to mine this data to suit your needs and try to find something that you can use. So I've done that for every single year on our data. Again, if we sum all the gaps, there was some interesting. You can see here 2009. There was a very high number of sorry, not a very high number. The gaps, if you sum them, the gaps were negative for the year, which is quite unusual. Then on the third stage, what the other calculation I've done is I've calculated what was the year gain. So that calculates everything, the day session and the overnight. So it includes the gaps on a year basis. So what was the gain? And I put it here on row 13. You can see the calculation there, and it's just a percentage. And you can see it all the way to 2021. And then I did a similar calculation, but in this calculation, I've only considered the gains or losses during the cash session, so no overnight. So didn't take into consideration any gaps up or down, just the session. And I've placed them here. And there's also something very interesting where that you can immediately see looking at this data. You can see that in general, the year gain, considering the entire how should I phrase it, entire overnight and the day session, is very approximate to the gain just considering the day session, and it's very similar. And I'm not analyzing if it was an up year or a down year, like here from 2008 was there was a big correction on the Standard & Poor's 500. So I'm not talking about this. I'm talking how similar the values are. There's a big difference here in 2009, but it's the only one. But when you reach 2013, going forward all the way to 2021, something is quite interesting. You can see that the overall gain is always bigger, no matter what, than the gain just for the day session. C, starting from the C, says roughly like 6% different, 4% different. Here it's just about 1%, but here another 2.5%, more or less, and then here 11% different, 7% difference, 12% difference, and all it goes. Very big differences if you consider the entire gain for the year or just the gain during the day session. And what is this trying to say? So what he's saying is that it seems to be that a lot of the gains are done overnight on the gap. It seems that the bulk, the lion's share of the gains is actually in the gap ups. So there is, yes, of course, a gain during the session, but the lion's share, the big gain, seems on the gap. So if you're only invested or trading the day session, you're actually losing out in a large chunk of your gains. And even, for instance, 2018, which was power, which was a down year. If you had only been in the markets during the cash session, your losses actually had been bigger. So there was actually, it implies is over 2018, there was several gap ups, and those were on the upside because overall the losses were smaller had we been fully invested all the time as opposed to just the cash sessions. So it's just looking at that simple data set is very interesting. And of course, if you want, you can just look at I've highlighted just some examples. Again, I'm not trying to take any conclusions on behalf. This is just some of my conclusions that I've ascertained just by looking at the data. The point of this video is to show you how simple you can put your own data on Excel, do some simple calculations, and then you can look at your own conclusions, or you can even look at different aspects of this data in regards to gaps. We're just talking about gaps, and of course you can do this for any instruments, for a specific stock, for a futures, for an FX pair, for a commodity, anything. So the principles are the same, and it can be applied again and again. But again, just to do one more quick analysis, just looking at the sum of the gaps, and this is just the gaps, does not take into consideration any gains or losses during the cash session. So just the gaps. And you can see that in general you had quite small, so there was not much, the gains over the gaps or losses are not overly very big until 2013, again with the exception of the 2009. But then again, from 2013 to 2021, you could start to see this very large gains overnight. It's like frequently the market opens with a gap up, so the open is much higher than the previous day's close, and it seems that most of the gains are on the overnight. Almost like if you're only trading or investing overnight, you'll be making most of the gains, which is very interesting to see how the market character, how the market behavior changes quite, I wouldn't say dramatic, but changed quite in a very accentuated way from 2013, and it seems still to be an ongoing trend where most of the gains are overnight. So by the time the cash session happens, you've already lost most of the gains. Anyway, I'm finishing here this video to keep it short. I hope this opens some glances on what you can do with gaps. I am sure that in the future to produce more videos on how to do further analysis on gaps. This is just some very basic, and I'll show you very simple how you can do some quick analysis, very simple formulas using Excel, nothing complicated, to just, for instance, check if there's anything that you can benefit from looking at gaps. Thank you very much for watching. I hope you find this useful and inspiring, and I hope to see you soon. Bye.